Here is an easy life insurance saving strategy that you can start 5 to 10 years before retirement. Let's get into it. We're going to look at a real life situation where a couple a few years out from retirement has about $75,000 sitting in a bank. Now they also have about $1.5 million in investments, a paid off home worth $200,000, but regardless of how much money you have, way less, way more, it doesn't matter. It's the principles we're going to talk about today that you can apply to yourself. They're still the same. So before he employed the strategy, he just has that $75,000 sitting in a savings account. Now it's a high yield savings account, so he's actually getting some good interest from this, around 4%, but that's before taxes. Now let's look at the difference when we employ this life insurance strategy. That is through, we're using what is called indexed universal life insurance, but we're doing that by maximum funding it. Essentially, he's going to fund this policy over the course of 5 years. He's currently 2 years into doing that, so he's going to move over $70,000 in total. He can move in $14.15 thousand in the first 4 years. The difference in the last year, so after 2 years, he's currently put in $28.3 thousand. But before we get into too much detail on how that works, and we will later in the video, but the money is going to grow and he can access that income tax free. So it's going to grow more than the high yield savings. He's not going to have to worry about taxes, and it's going to have a death benefit there that's tacked on. So if he passes away early, that goes and takes care of his spouse. And also, since it's life insurance, that death benefit passes on tax-free. So 2 years in, he has $28.3 thousand that's already been funded into the policy. Now they are front-loaded with fees, just like a mortgage. Up front, with most kinds, you're going to pay much more towards the interest until you start digging into the principal. With a maximum funded indexed universal life insurance contract, you have those early year fees that you're paying off. You're not going to see a strong internal rate of return until 10, 20 years in. And we're going to show that because currently, as you can see, he's funded the policy with $28.3 thousand, but he only has $24.9 thousand in his account value. Now also a small side note here, we didn't really adjust for more money coming into the bank account or the investments growing at all. For this example, it doesn't matter so much. And here's a look at this actual policy just to show this is a very real scenario, but his current account value is that $24.9 thousand. And here's the death benefit that was tacked on. Once his cash value surpasses this amount, it's actually going to grow and stay a little bit ahead of the account value at all times because it has to still be considered life insurance. Otherwise, you don't get the benefits that a life insurance policy gets in regards to taxes. So if he passed away year one after funding only $14.15 thousand, his wife gets the full $168.9 thousand income tax free. Now that's not why he's doing this. It's just there along for the ride. It's awesome if he is to pass away that his wife is going to get much more money than she would have otherwise, and it all happens tax free. But he's more so just using life insurance to do this because of the tax treatment that life insurance gets. We'll get into that more later. What would it look like in 7 years from now? That was today, that was just 2 years after, but if he continued to fund it, he'd be finished funding it after the 5th policy year. Then if he had around, and this is just according to the projection, $73.9 thousand in there, he funded it with $70,000 total. So the internal rate of return, retroactive back to day one, doesn't look very great. In fact, it's 1.35%. If you just kept the money in a high yield savings, at this point, after 7 years, the high yield savings, assuming that it actually stayed at a 4% rate and interest rates weren't cut, if that was the case, then the high yield savings, of course, would have well outperformed this strategy. But again, we're not in this for the short term. This strategy simply doesn't work if you're only wanting to do it for 5 or 10 years. It's fine if you only want to fund it for 5 or 10 years, but the point is that you're going to keep this intact throughout your whole retirement until you pass away. Otherwise, it simply doesn't work. You can click off the video now. Here we can see the policy is fully funded. The bank is to $20,000 now. He's put some more money in the bank. And again, we didn't adjust the investment money here at all. That doesn't really matter for this example. Now let's look, this was after 7 years. What are we projecting after 20 years of doing this strategy? We're not putting any more money into it. It's just those first 5 years, that's $70,000, and then letting it grow income tax free. Still keeping the bank and the investment the same. Now we're looking at, this is just according to the illustration here, $166.7 thousand. The internal rate of return, which takes into account how much money you put in and when you put it in, all the way back to day one, after 20 years, is 5.217%. That is income tax free. So if you're getting 4% in a high yield savings, well, you're going to have to pay taxes on that each and every year. It's taxable as ordinary income. If you are doing this inside of a life insurance policy, since it's not considered an investment, it's considered life insurance, you don't have to pay taxes when you access that money. So after all fees, after all taxes, so this again is taking into account all of those early year fees that you paid that made it look pretty ugly 7 years in, 2 years in. But once you get to 20 years in, that's where you get, after all those, the 5.217% income tax free. So first, let's look at a comparison, and then how is this actually possible? We'll get into that next. First, if you just had the money sitting in a compounding 4% a year high yield savings account, again, assuming that the rate stayed that throughout this 20-year period that we're going to look at, how would that compare to if you had max funded an indexed universal life insurance policy and let that grow? So first, after 20 years, just according to a projection, with the high yield savings, you have $134,455. Now this was assuming a 22% tax rate on this money. So if you're gaining 4 and you take 22% off the top, that's what that's assuming each and every year. So at the end of 20 years, you have $134.4 thousand, and that's if you started with $75,000 in the high yield savings. With the indexed universal life insurance, you're funding it slowly over those first 5 years, and then you really don't even break even until year 6. Year 7, there's that 73.9 that we pointed out earlier, and at the end of 20 years, that's where you have the $166.7 thousand. But keep in mind, you funded the indexed universal life policy over 5 years. That means over that 5-year period when you were still funding the policy, there was still that money sitting in a high yield savings account getting some interest while it was waiting to be put in. And after all of it's put in, well, there's still some money left over. Why? Because you didn't fund the full $75,000 in the first place, you just funded $70,000, and the rest of the money made some additional interest in that time before it went into the policy. So that money over here, this would be the high yield savings account balance if it was continuing to get 4%, taxed at 22%. So after the 5 years, you can see it's pretty low there. The $70,000 is now gone. We're just left with the interest we just earned in those 5 years, plus the additional $5,000 that was sitting in there that we didn't put into the policy initially. Well, that money is also going to continue to compound if we're assuming that 4% high yield savings account. So when we take that into account, we're also left with another $16.76 thousand that's sitting in a high yield savings account after taxes. If we add those together, we're left with $183.5 thousand compared to the $134 if we had just kept the money in a high yield savings account. That's almost a $50,000 difference over the course of 20 years, and that's $50,000 you don't have to pay taxes on when you want to spend it. So that's the first thing. Second, if we're just looking at the indexed universal life versus the money in the high yield savings, after a 22% tax bracket, you have a 3.12% internal rate of return with the high yield savings, and you have the 5.217, so almost a 2.1% difference in internal rate of return once you factor in taxes. Couple other things. If your spouse, for example, were to die in year 10 with the high yield savings, we have the money here, $98,889. That passes to your spouse, income tax free because it's already post-tax. It would have to go through estate taxes, but in this case, if you have such a low net worth, you're not going to have to worry about that. That passes to your spouse. With the indexed universal life, if you remember, we had that $168,000 death benefit. And since the cash value at that point, $86,000, is still well below that, that death benefit wasn't going to go up at all. It was going to stay the same. Since that's the case, the wife would get the full $168,000 income tax free. This goes the same if you were to pass away in year 1, 2, 10. It does not matter. It's only when the cash value starts to surpass the death benefit is the death benefit will actually grow and always stay a little bit ahead of the cash value. Otherwise, they don't legally consider it insurance, and we want them to do that so that we keep getting the tax benefits. Couple other notes here with the high yield savings account. These are going to be a little more advantageous in the fact that you can spend the money immediately. So if you have a high yield savings, you can transfer the money to a checkings account or spend it straight from your savings, whatever, and it's done. You had the money in your account, you spent it. With the indexed universal life, that's not the case. Usually you can access within a week, usually quicker, but you're just going online into your policy portal, filling out a form, they send you a check, check's in your mailbox. If you want to do overnight delivery, perfect, you got it there, you can spend it then. But technically it's a little bit harder to spend the money because you have to fill out a form and they got to mail it to you. Pretty easy, but it is worth noting that you can spend the high yield savings money immediately. Second, rates could of course rise and drop with the high yield savings. If the Fed raises interest rates, then the rates might go up. If they go down, then they might go down. Same thing with the Index Universal Life. The policy could perform better, it could perform worse. We just looked at a projection. I'm going to show why that is in a second when we explain how this works and how this is possible. And then finally, with the high yield savings, it simply requires just opening an account, transferring your money, and it's done. With the Index Universal Life, this requires some long-term thinking. Like I said, if you want to do this for 5 to 10 years and be done, it's not going to work. It's not going to look very pretty. If you realize that you're going to do this and hold the account throughout your entire retirement, that's where we're going to start to see these benefits long-term. If we don't do that, the high yield savings is going to be the better vehicle. Now, how is this possible? I have some videos that go into much greater detail on this, but today we're going to keep this very high level, very simple. Essentially is you are the person who's actually going to buy the insurance, going to the insurance company and purchasing life insurance. The difference is you're not really too concerned about how much insurance you have. You're doing that for the benefits that come along with that. Now, when you buy insurance, essentially you're going to want to ask them, hey, I want the most amount of this premium that I'm going to pay you to go towards the cash value and the least amount possible, as defined by the IRS, to go towards the death benefit. That way my policy is still considered life insurance, but I have this cash value that's going to grow for me that I can access tax-free because of those tax codes. Now that cash value is then going to get credited interest from the insurance company. The same way that because interest rates are higher, banks are able to credit you interest in the high yield savings, insurance companies are able to do the same thing. Now what that interest is going to allow your money to do is to link your cash value to an index. So I'm going to write link to, for example, the S&P 500. What this means is it's like your money is invested in the S&P 500 with a floor and a cap. Basically just meaning if the market goes below your floor, you can't go below that. If it goes above the cap, you can't go above that. If it's in between those, you match it. Now your money is not actually invested in the S&P 500, but more or less it's like it is with a floor and a cap. What that means, just to give a quick example here, is let's say the S&P 500 over the course of 1 year went up 12%. Well, if you had a cap on your index of 10%, then you hit your cap. You can't get 12, you can only get 10. That's the maximum that you can get for that year, so you would get 10%. Now, if the market went down, let's say 20% in a given year, and you had a floor of 0%, then are you going to lose 20% like if you had your money in the S&P 500? No, you're not, because you have a floor of 0%. Just like you can't go above the cap, you can't go below the floor. So it's not about trying to hit home runs, it's just about hitting consistent singles, playing it safe, and slowly making those gains over time. That's how this could actually be lower, it could actually be better. Over time, especially in this case, the goal isn't necessarily to outperform the market, we're just trying to outperform where we were keeping our savings, and in this case, do that in a tax-free environment. The illustration we showed, after all fees, 20 years in, we had that 5.2%. It's also after taxes. Obviously, that's going to blow the high yield savings out of the water. Now, this cycle would repeat year over year. Once you make a gain, that money's locked in. You're not going to lose if the market goes down the next year due to that. You locked in your gains each year. This cycle will continue to repeat. Now, because this is life insurance, you get the tax treatment of life insurance. Now, there's 3 main tax codes that I'm going to write down here, and that is 7702, 72E, and 101A. 101A says that when you die, the death benefit of a life insurance policy is going to transfer tax-free. So that is the death benefit portion of things when it comes to taxes. If you've ever received a life insurance policy or you were the beneficiary of one, you would know you probably didn't have to pay any taxes on that. That's because it's life insurance. Second, I'm going to lump these two together as 7702 and 72E. Essentially, this says that money inside of a life insurance policy or the cash value grows tax deferred. Now you can withdraw this money taxed first in, first out. That means everything that you put in, you can withdraw income tax free. Everything above that, you do have to pay taxes on if you are withdrawing. However, that's not how you are going to access your money. That's not how this strategy outlines accessing your money. Instead, what you can do is access this money tax-free through what is called, I mentioned before, a policy loan. Since you are loaning the money out, it's not considered a withdrawal. You are able to take this money tax-free and spend it how you like. And even though you might be loaning at, let's say, 2%, for example, the insurance company is actually going to credit you an equal and opposite percentage, say 2%. So even though you're loaning at 2%, and yes, you do have to pay 2% interest on that money, the insurance company also credits you an equal and opposite percentage. That's why it's called often, or referred to as, a zero wash loan. You gotta pay 2, but we'll also give you 2. There's your little workaround. The money's still tax-free. You don't have to pay taxes because you withdrew more than you put in, taking advantage of that tax deferral status. So that's how it works. One major warning is if it is not structured correctly to where most is going towards the cash value here and the least amount going towards the death benefit, the internal rate of return is not going to be near as good as if it was structured correctly. Also, it's going to pay the agent, the person who set this policy up, much more money than it would otherwise. I'm talking 3, 4, 5 times as much money. You need to have your policy structured correctly with an agent who does this regularly, who understands the ins and outs of the policies, how to set them up, all of the different intricacies, etc. Otherwise, this could be a disaster. So just be careful when you're looking into this strategy. Now, a couple other possible uses we're going to look at if this is the case, then you could do that. Number one, if you have a pension, Social Security, or an annuity that you are receiving for retirement income for you and your spouse, it would stop after you pass away but would not transfer to your spouse, then you could also lower the internal rate of return, or as much money as you're going to get, to increase the death benefit to make sure if she passes away, she could replace that income and continue receiving just as much as she would before, and she'd get that death benefit tax-free. If the non-insured spouse passes away, you can change the beneficiary and leave this money to your children. If you get a chronic, critical, or terminal illness and you qualify and prove to the insurance company that that is the case, you'll actually be able to access some of this death benefit while you're alive. So even though usually you get it when you pass away, you can do some of that while you're alive to help pay for some of those medical costs. If you want to take income, take a vacation, or any other use, of course, you can access the money tax-free through a policy loan. And finally, if you receive an inheritance and you've been taking policy loans, well, you can lump sum as much of that inheritance into your policy, have that start growing income tax-free immediately as much as your loan balance is. So if you have a $200,000 loan balance, you get a $500,000 inheritance, you can lump sum $200,000 into the policy paying off the loan. It's back to full health. Now that money's growing income tax-free. Hopefully this video was helpful. If it was, please do subscribe. I release videos twice a week going into great detail, all things retirement strategies, real scenarios, breaking down the numbers thoroughly for US residents within 10 years of retirement that are looking for peace of mind. They don't necessarily want to put money in the stock market. They'd rather have guarantees and focus on the things that matter most to them. If that's you, subscribe, and I will see you in a future video.